Hi everybody, it's Andy Phillips here, and as you can see I've got our resident tax expert Mark with us.
Good morning.
How are you today?
I'm extraordinarily well, thank you. The sun is shining. It's the last day of my holiday, and what better way to end my holiday than talking with the Pin family?
So, well, yeah. We appreciate it. We appreciate you coming on and doing something with us today. We're talking about extraction of dividends from companies.
Yep.
Again, this is one of the things is when you actually start putting a company together and building a business, this is a really key thing for where you're going to get your cash from and all that sort of stuff. It's a perfect thing for a lot of the Pin family, because a lot of us are building these businesses. We're creating sort of legacy for later on and things like that. So we need to get it right. We need, we talk about this every time. We need to get our tax right. We need to get our tax in the right places at the right time and understand how it works. So shall I share your screen?
Great.
Okay, let's get this up on screen. Okay, we're cool.
Great. So good morning, everyone. So extraction of dividends. Yes, we talk about this all the time. I'm going to be talking about the people that DIY their formation. You shouldn't be doing it. Please get advice. But often people at DIY, you'll see an example later on of where it goes wrong. So, okay, let's crack on. So that's what we're going to talk about today. This is who I am. Reasonable size firm now. I think there's 46, 47 of us now. I'm personally a commercial and residential landlord. I was a property developer, so I do walk the talk. Been doing this been a landlord now for 25 plus years. Important slide, I say this every time. The presentation I'm going to do today is literally skimming the surface of these things. You must not take action or refrain from taking action based on the information I'm giving you today. I'm really just trying to tell you what the questions are so that you can then go and get professional advice based on your circumstances, either from your accountant, or if your accountant's not up to snuff, come to us. If you want to come to us, you'll see at the bottom of the screen an email address. You'll notice that it's pin@. The reason for doing that is if you come through, then I know you're part of the Pin family, and therefore we'll try to accelerate you up the queues of people that want to get some free advice. Okay, today's topics. When we're creating a company, obviously we're looking to how are we going to extract cash. We want profit from the business. So we're going to be looking at the proper process to declare interim and final dividends. Now I know people say, oh no, Mark's going to talk about paperwork again. Yes, I am. And I know I'm talking about paperwork. I always do it. But if you don't get the paperwork right, you don't get your logic sorted out, you don't get the process done properly, you can get into trouble. You can end up trying to do things like waivers, which is a red rag to a bull, talking about this in some detail. And lo and behold, if you get it really badly wrong, you'll end up with an illegal dividend, and that's going to cost you a fortune, basically. So let's crack on. Proper process. Let's look first of all at the legal requirements to declare a dividend. First of all, you have to understand the company is not you. And it's one of those fundamental things. It probably takes about a year for me to get new business owners to stop talking about, I'll pay that bill. Well, actually what they mean is the company's going to pay the bills. The company's a different person in law to them. Therefore, when you do something as either a director or shareholder, you've got to make sure you've got the authority to do it. Now, that authority is within your articles of association. If you've just gone into company's house and formed a company, or you've got us to do it, that's fine. The authority will be there. If you've got an old company prior to the 2006 Companies Act, which only came into force in 2009. So if you've got a company prior to 2009, just check that you've got the authority to declare the dividend and what the process is. This is the important one, folks. Distributable profits. The Companies Act says, and I know I've just talked about the Companies Act 2006 and companies formed prior. The authority, whilst I'm referring to Companies Act 2006, it applies to whichever date your company was formed. So these rules apply. You can only make a distribution of profits from profits that are available for the purpose. That's what the Act says. Now, what the heck does that mean? What it means is you've got to make sure that you've got the profit available to you and that you've gone through the proper process to make sure the profits are available before you declare them. So how do you do that? Dead easy. It's your accounts. Management accounts are the accounts you produce during the year to see how the business is going. This is not simply a case of, I've got some cash in the bank, I'm going to take the money. That's not management accounts. That's just striping the business of cash. Look at your management accounts and your year-end accounts, your final accounts. Now, if you happen to be a VAT registered business, we know that you're going to be producing management accounts on a quarterly basis anyway. It's the timing that we recommend. You don't have to do that. I'll talk about timing in a bit more detail. But have the accounts in front of you, because you've got to make sure that you have made provision for your tax bill, for any accruals, that you have taken proper account of the availability of profits. And the important one is that you've got the ability to settle liabilities as they properly fall due. Now, those words might be ringing some bells for people. This is the definition of insolvency. Has the company lacks the ability to settle its liabilities as they properly fall due? Now, there is more words for insolvency. That's not the end of the sentence, but it's the good guide. So now we're not just saying, is there cash in the bank? Because that cash might well belong to the taxman. Have you paid your tax bill yet? Have you paid your VAT bill yet? Have you paid your PAYE? Have you accrued for the costs that you've committed yourself to? Have you got provision for these monies? You can't take the cash and then suddenly find you've run out. I'll be referring to COVID and what happened. And I won't do it now, but we all know what happened where people, first 2 weeks of COVID, they go, I've run out of money. What do I do? It's because you ran your business badly. So let's look at the different types of dividend. There are two. An interim dividend is the dividend you declare during the year. So it is interim, it's not the final. It is in the power of the directors to decide this. Whereas your final dividend, only the shareholders can approve. Now, again, you might now say, hang on, Mark, it's a single company. It's your company, you're the director, you're the shareholder. Yes, but we've got to deal with which version of you are we talking about. So bear with me for a second. If you're a client of my company, you'll have had this speech. I'll keep it fairly short. I think every single business owner, me included, Andy included, suffer from schizophrenia. There are 4 Andys in his business. There are 4 Marks. I'm a worker. I'm actually working right now. Talking to you is part of what I do for my work. I'm working. Sometimes I make decisions. I'm a director. Once a year, I'm a shareholder. In fact, for me, once a quarter, because I take my dividends quarterly. But also, if I'm putting money into the business for the deposits on property, for example, I'm also a bank. So there's actually 4 of me: worker, director, shareholder, and bank. So which one is speaking right now? Well, right now it's the worker is speaking. But when you create your interim dividend, it's the director that speaks. When you create your final dividend, it's the shareholder that speaks. And you've got to have this process and the paperwork right for this. Let's go on to part 2. How much dividend should you declare? I am going to start my COVID conversation now. Think about when COVID first started, the lockdown. Everyone went into apoplexy. We've started seeing people taking holidays from their mortgage payments. We told you not to do it. Now it's happening that the mortgage companies are now restricting your borrowing. Why? Well, it's because you didn't leave enough money in the company to even ride a few weeks. It was only literally, there were people taking holidays within the first week, 2 weeks. They couldn't even ride a week without cash because they'd taken all the money out. So we believe that you should always think of the company first. What does the company need? So, well, I'm going to tell you something private. I know it's ridiculous. I'm talking on a public forum and recording, etc. But it is personal to my business. You'll know me. You'll know my business partners. When we create a business, we set a set of rules that said, and actually the figures we use are 80, 80. 80% of all profits must be retained inside the business. So I've only got 20% available to me, and I'm sharing it with my business partners. So there's two of us, so maximum I've got is 10%. Why am I keeping 80%? Well, I've got to keep the company alive, because it's the thing that's going to pay me in the future. So I need it to be wealthy. I need it to have cash. Now, I know everyone keeps talking about leverage, borrow up to the hilt. I don't personally agree with it. I know you have to do it when you first start, but get past that as quick as you can. Keep some cash in the company. This is where you're dealing with your schizophrenia, because if I'm declaring an interim dividend, I need to create board minutes of my meeting of the director. Yes, it's only me, but I need to create those minutes because I've got to specify it was me speaking as a director, declaring some dividends to me as a shareholder. Bit of schizophrenia going on there, folks. At the year end, you get your final accounts. Now, the director proposes the dividend, which the shareholder agrees with, and then the shareholder makes the decision. So you've got to have this paperwork done. You need your minutes of meetings. This is all part of work that's called company secretarial. You should be recording when you borrow money, when you buy a property, when you remortgage. You should be recording these things as to who of the four people, worker, director, shareholder, or bank, made the decision. Okay. Should also create dividend vouchers. Now, technically, you don't actually have to, but good audit trail, good process. When you have your minutes, so I'm just checking to see what my next words were. When you have your minutes, if you're doing your interim dividend and when you do the final dividend, I've said to you, have your accounts in front of you. So now think what those minutes now should say. The minutes say, Fred Bloggs convenes the meeting, he declares that quorum is present, declares a conflict of interest because he's going to declare a dividend to himself as a shareholder. And he sits in front of him and has the management accounts. And he looks at the management accounts and says, yep, there's some profit available. I'm going to keep this percentage back for the company. Therefore, this is available for declaration of dividend. And I am planning to make a dividend declaration of per share. When you've finished your minutes, attach the management accounts. Because what we're showing is at that point, contemporaneously, it was proper for you to declare a dividend. You were legitimately claiming a dividend because you had checked your accounts.
So in other words, like a snapshot of the account.
There's a snapshot
of the account at that time.
There's a statement. This is where we're at. Now, if you can visualize, let's visualize a company that's got its year end is September. Let's just imagine a company's got year end is September.
Yeah.
First quarter, Christmas, great, declares a dividend, whoopie up, they can have turkey this year. Well done. Now we're going to get to March. Excuse me, the business has made a profit, declares a dividend because he's got his management accounts. Damn me, COVID comes along. Collapses the business in the third quarter. Now, it might well be at the end of the year, the business didn't have enough profit to declare a dividend that has already been declared. But at the point when you made the decision, you've got the evidence that said you did make a legal dividend declaration because you had the accounts. The money was available. You couldn't see COVID coming because no one else could see it either.
Yeah.
Okay. Now we come to how often do you declare your dividend? Personally, I like quarterly dividends. Now, again, I'm telling you personally what I do. I think it's not a bad thing to try and do. What I do is I declare a quarterly dividend. So I might well declare a dividend. Just use my example. It's now got to March. I've declared a dividend. And I'll declare a dividend of a reasonable size because I've made a reasonable profit. Very good. But I don't take it all. I personally like having my money monthly. I'm used to running my life on monthly income. I'm sure if I suddenly got a great big chunk of cash in the bank, I might well spend a bit more money on more golf clubs, and Andy might spend some more on drums and snare cymbals and things. I don't want it. So I'll leave the money in the company in my account inside the company, and I'll draw down money every month from that for me to live on. Hopefully to spread my cash out so I can get to the next quarter and go, well, yes, I've had a good quarter. I'll declare another dividend. That's personally what I prefer to do. You are allowed to declare a dividend whenever you want. If you want to do it monthly, you can do.
I guess quarterly would be a good way of actually keeping a tab on exactly where you are, not only where the company is, but where you are as a director, where you are as an employee, whatever. It just keeps a better tab on it. If you're drawing down monthly money from a quarterly dividend,
Yep.
it just keeps a rather than doing it end of year or something like that, because that'd be quite difficult to manage, I think.
Well done. I promise you, folks, Andy didn't see my slides in advance. Okay. And he didn't know what I was going to say. So the next sentence was going to be, I think it's great quarterly because, let's imagine you're VAT registered. You've got to produce your VAT return on a quarterly basis. As a minimum, have your management accounts available. You must have your management accounts available. You've just produced your VAT return. You know what your sales are. You've looked at all your costs. You're worried about, can I pay the VAT bill? So pay the VAT bill. Keep your provision for your corporation tax. Now you know what money is available. You've got your management accounts. If you want to declare monthly dividend, you've got to produce management accounts on a monthly basis. Good thing to do. I'm not suggesting it isn't. Obviously, we do. But most people don't. They might do it quarterly. Now you've got your contemporaneous evidence. So absolutely, I personally think quarterly works very well. The idea of taking a huge amount of cash and me having to filter that out through my life for a year, I wouldn't do it. I'd have big holidays at the beginning of the year and I'd spend some cash. I know I would. Tax planning. Dividends are great for tax planning. We know that the country is now into some financial straits. The government debt is just horrendous, where they've been propping up the economy. We're bound to have some tax changes coming. This is not the presentation where I can talk about what I fear might be coming. I don't know what's coming, but I fear coming. But at the moment, dividends are certainly a good way of tax planning our income, making sure if your wife's in, your spouse, sorry, that was majorative, I apologize. Your spouse or your partner's involved in your business, that person may have some shares because you can start to share income around, etc. And of course, inheritance planning, you might have your kids involved. You can't declare a dividend to a child. You've got to wait till they're 18 to declare a dividend. Otherwise, you get taxed on their dividend. But tax planning is something you ought to be doing. And I'm going to bang an old drum. We think you need to be doing this extraction of cash tax planning when you create the company. It's not an afterthought, right? So do it then. Taxation of dividends, very simply, the company pays tax and therefore you're paying dividends from post-tax profits. So the companies already paid dividends, so don't get too excited. You paid 19% tax, you've got 81% left. Now, if you take a dividend, the first 2,000 is tax-free in a year of total dividends. You can't, not 2,000 per company, 2,000 in total. Then you pay 7.5% up to your standard rate band, 32.5% in the high rate band, top slice 38.1%. The beauty is there's no national insurance. When I talk about what I fear might be coming, I'll just give you a headline of it now. There's been a huge number of complaints by business owners saying it's not fair. The government didn't support us. I sympathize with them. I just don't appreciate them moaning like this. They don't pay national insurance. The employees pay lots of national insurance. Self-employed pay national insurance. Directors, shareholders, we don't generally pay national insurance. We pay less tax. It seemed appropriate that the government didn't give us quite the level of support they gave to those that pay more tax. I'm quite happy not paying tax for 40 years of my life. And I didn't want to moan for 2 months because the government wasn't giving me a handout. But people are probably throwing things at their computers now by hearing this, but I apologize. But I think moaning because we couldn't get a little bit of support during COVID was a bit of a mistake. The government will use that, I think, against us now and may well change the tax mechanism of our income as business owners. If you're a client of the firm, we've created, you'll know that we have these things called BiteSize Tax, which is a briefing document. I do want feedback from the briefing documents people. So we've created a lot of them. You can see I'm up to number 105. You're welcome to have that if you're a client. Just email us and ask for BiteSize number 105, and it will deal with the process of declaring dividends. So let's imagine now you didn't form your company sensibly. You were penny wise, pound foolish. You went and DIY'd this. And you now want to declare a dividend. There is an example coming up in a moment. So I'll just get through these first 2 points, but then I'll get to the example and spend a little bit of time on that one. A waiver. A waiver is, so let's imagine me and my wife have formed a company. We haven't. I have a big income, she doesn't. And I say, well, I don't want to wait. I don't want to take a dividend. Thank you very much. Give all the profits to my wife, please, because she's a lower rate taxpayer and I'm a higher rate taxpayer. So I would waive my right to my dividend. That is what a waiver is. But there's got to be a commercial justification for the waiver. Just visualize this now. Visualize that you've got some shares in British Telecom. And you think, oh, poor old British Telecom. I'll tell you what, and you write a letter to British Telecom saying, when you come around to paying the dividends, I'll waive mine. Thanks ever so much. You keep the cash. I don't need it. Thanks ever so much. Who would ever waive their right to a dividend from British Telecom? They wouldn't.
Yeah.
Would you do it for your business? Now, you can't say, because I want my wife to have the money and pay less tax. You've got to have a commercial reason for it. So you can do waivers. So let's visualize the situation now. Andy and I go into a JV relationship. He's such a wealthy man. I do the bulk of the work in the business. I've got 75%. Andy's the cash investor. He puts 25% in. Might not have a lot of profit in the company. So I say, look, I think the company needs to keep the cash. So I'll waive my right to my dividend, but I want to reward my JV partner, Andy. So you can have your dividend, but I'll waive mine. I'll leave my cash in the game. I've got a commercial justification for doing that. Right? It isn't because I want to protect my tax and benefit myself by giving Andy some money. Can't be brown envelopes or anything like that. You've got to have a commercial reason. So here's the example. Oh, proper process for a waiver. Sorry. Proper process. You've got to waive the right to the dividend before the dividend is declared. Okay, you've got to waive it, and you've got to do it in writing, and it's got to be sent to the company. Well, how do you do that? Well, you'd have heard me speak about this before, probably. Write to your accountant. Write to your accountant to say, hey, Mark, I've decided that I'm going to waive my dividends so that I can make sure my JV partner has his, because I want him to be rewarded for his risk. I'm going to waive mine. Please note this onto my files. What you've done is you've created a contemporaneously dated and timed document with a professional that says you're doing it.
All right.
Okay. So here we've got a story. Husband and wife own a company. He's got 75 shares. She's got 25. They made a profit of 50 grand. The husband has a job. He's a higher rate taxpayer, declares the dividend, and he waived his right to the dividend, saying, don't give it to me. I'm a higher rate taxpayer. Give it to my missus. So he gave the waiver, declared a dividend of £2,000 per share. She's got 25 shares. She gets 50 grand. Only leaves £8,000 profit. This is a real case. This actually went through the courts. It was challenged successfully because the company could not declare a £2,000 per share dividend. There wasn't enough profit. She's only entitled to 25% of the 58. So the maximum she could have taken was £14,500. She could not have claimed 50 grand. It was done not for any commercial reason. It was done purely for tax avoidance.
Right.
And it was overturned. So please don't do it. There is a way to deal with this. Again, get advice when you're forming the company. Do not be penny wise, pound foolish. If we had said, so let's imagine this isn't a husband and wife. Let's imagine this is Mark and Andy again. We're doing a JV. Andy's 25, I'm 75. Good. Why don't we create share classes? Why don't we create a share class for the doer? So Mark has them. And why don't we create a share class for the financier? Andy can have them. Now when we declare a dividend, we say we're not going to declare a dividend for the doer because we haven't made enough profit, but we are going to declare a dividend for the financier. So I didn't have to do a waiver. We just didn't declare a dividend for my class of share, but we did declare a dividend for Andy's class of share. Simple, but you've got to form the company properly to start with.
And the class of share, what does that actually mean? Does that mean that my share would be a different type of share to yours?
Yeah.
Right.
Generally, we use the phrase alphabet shares. HMRC hate them as well because they know exactly what we're doing.
Yeah.
So there's got to be a commercial justification. So that's why I'm using the phrase of financier and doer. There's a reason to distinguish us. Right. Now let's imagine it's a husband and wife, and it's the wife who has inherited money and she's putting that money in. Well, fine. She's different to the husband. She has got an inheritance, not they have an inheritance. She has an inheritance. Fine. Recognize that she's different. It might be the husband who's the grafter, the doer. Recognize that he's different. So if there is a commercial justification for a share class, good. And you know the next phrase, write it down, send it to your accountant. Again, if I form a company, I will write it down, and I will write it down and say, well, we're creating these share classes because. Okay. You want this distinction between the individuals, and there's got to be a commercial justification.
No, that's the key point, really, isn't it? It's the commercial justification of a share payment.
Yeah, right. You can't just be, I fancy screwing the tax man.
Right.
I know that's plain English, folks, but hopefully you're with me. You can't just do it to mess around with the tax man. That's not the point. Yeah. Again, for clients, there's a bite size. It's number 106. I'm being a bit slow today. I think I've got 2 or 3 minutes left.
You got
great. Go on to the last topic, if I may. Illegal dividends. Leave that at the top of the page for a moment. The word is ultra vires. Ultra vires means outside of your power. Now, do you remember the schizophrenia? Worker, director, shareholder, bank.
Yeah.
Well, the director making a dividend declaration, if he shouldn't have made it, he was doing something that he did not have the power to do. He was ultra vires. So the first point to say is the word illegal does not refer to a criminal offense. It just doesn't. It just means you've done something that's ultra vires. Outside of your power.
Yeah.
Outside of your power. You shouldn't have done it because you didn't have the power to do it. It goes all the way back to my first slide that said, have you got the power to make a dividend? Right? Which is your Articles of Association and the Companies Act 2006 that said these are the criteria. Okay? So if you've made, I'm going to use the word illegal, but I don't want anyone thinking this is criminal. If you've made an illegal dividend, how the hell do we fix it? Well, first of all, let's look at what caused it. Usually, you didn't have your accounts available. What it means is you've looked at the bank account, you've said, I fancy a holiday. Yeah, there's some cash in the bank, I'm taking it. You didn't do any paperwork, you didn't do your accounts, you didn't do what Mark said, you just took the cash. Lo and behold, COVID comes along, now you haven't got any, now there's no profit. You can't declare the dividend. You haven't declared it, you can't declare it. So if you've messed up and just not bothered to be competent as a business owner, I'm sorry, I know that's strong language, you can get yourself into trouble. You have to remember that part of your responsibility as a business owner is to run the business effectively and efficiently. You can't just say, well, yeah, the money was there, I took it, it was in the bank. What does that mean? It just means you didn't pay your bills. So that's the lesson from COVID, wasn't it? All these people had taken all the cash out that they could. Now, I know I'm not criticizing people. I know that people had formed businesses just before. And when you form business, yes, you leverage to the hilt. You don't have spare cash. I get it. I'm not moaning at everybody. But businesses that have been running for some time, and they leverage and spend, and they usually have the sexy cars. sorry, you're meant to have left money in the business. You're meant to have protected the business. So make sure you keep some cash in reserve.
And this is really a mindset thing, isn't it? More than anything else. I mean, it's. I know it's easy to say. I mean, when you're putting this together, I mean, we've often talked about making sure that when you set the company up, you set it up in the right way, and most people don't.
Yeah.
Most people don't. What they do is they try and do it the cheapest, easiest, quickest route.
Yeah.
Because they think, I've got to have a company, so I'll just get one off the shelf and blah, blah, blah. And we've said time and time again that the most important thing, probably the key thing, is whenever you're setting a company up, is to do it properly through someone like yourself, mainly because it can save you so much money down the line, and so much heartache. We talked last time that it's not about the cash always. It's not always about, I've run out of money and, I've done a bad job with the company. It's all the heartache that goes along with it, and setting it up in the right way to start with. It takes all that stuff away. It takes all the sort of heartache, the pain, the lack of cash, and all those sort of things. All the things that you can get fined for. Setting it up in the right way right at the beginning is probably a key thing that comes back time and time again every time we talk.
I'm afraid it does. Again, people that know me, I use analogous language from these presentations. I do as well. It's always got that situation. Let's imagine now you live in Leeds. Okay, beautiful city. I've made a lot of money there, and I've got investments there. Great. You're going to get in the car and you're going to drive. There's no point in just getting to the junction of the M1 and flipping a coin, saying, which way shall I go then? The whole point is, where do you want to be? Let's look at what's the long-term plan. Let's look at how are you going to extract cash. Let's look at your inheritance planning. Let's look at these things, get it planned. Now we'll get a route map and we'll say, oh, look, when you get to the M1, turn south, will you? Because you've decided you want to go to London. Fine, go there then. But actually pick your destination in advance and set yourself up to aim at the target. You've got to have a target, aim at it, and that includes in your formation. So yes, it does. It's the same old story.
It is, yeah. I mean, it's basically what you said time and time again, and I think this is something which I want to get over to people as well, because this is the reason why we do these things, is that we start businesses up to achieve something. We want to get somewhere in our lives, and most of the time we set business up to either sell them or they're our life business. We want to get to the point of retirement and be able to sell that business or do something with that business and have a really good retirement. That's the whole point of working your ass off for 40 years or whatever it is, when you're running a business. So, it makes so much sense to just right at the beginning to say, where do I want to go? What's my route map to this?
Yeah.
And where does my hard work really need to be?
Yes. And I've got a client. I'm not going to name him and embarrass him. And he set a time frame, a target with me, and his target was 5 years from now, Mark, I want to be at this stage, and then 10 years, and this is what I want my retirement to look like, and this is what I want my eventual inheritance to look like. So we had these staging posts. By the clarity of having that and having that detailed focus, I've got to tell you that now, during COVID, he was so driven. He's made so much money during COVID, not from property. It was from property, but doing related stuff in property. He's actually achieving his year 2 target inside the first 6 months, and that was in the COVID period. Why? It's called planning and focus and being dedicated to your task. Brilliant. So in addition to me stopping him having problems and getting himself into trouble, which I do stop, the planning process alone helped him focus and achieve. So it's not just a negative to it. There's a huge positive by getting the planning process done.
Yep.
Okay, remedy. There are 2 remedies here. You're not going to like either one of them, folks. But there again, you shouldn't have got yourself in this place to start with. So remedy number 1. Now let's imagine you've taken this cash out of the business. There was insufficient profit to declare a dividend. Therefore, you've taken company money. And your company is now in trouble. Can you survive it? Probably not. Okay. So how can that money have legitimately got to you? Well, it can't have got to you because you're a shareholder. It must have got to you because either you're a worker or a director. Back to my schizophrenia thing.
Yep.
So yeah, declare a director's fee or salary. But now, of course, you're paying top rate income tax at your top slice, and you're paying national insurance, and the company's paying national insurance. So all of a sudden, this 50 grand you've taken out of the business is now probably costing you 80 grand because you've got all the taxes, etc. You've got to gross up. Okay, really bad news, folks. The alternative, and this one's complicated. Bear with me. As always, there is a briefing note for our clients. Can I just say to people, I've just got a piece of paper out in front of me. For those of you listening who are not clients and don't have the briefing paper, you can get information about this at HMRC. The reference number is CTM, it's a Corporation Tax Manual, 20090. CTM 20090. Right. So now, let's imagine now you've taken your 100 grand out of the business. There was insufficient profits. You couldn't declare the dividend. So maybe you've had a loan from the company. We've got to define what this money was. It wasn't a dividend. Was it a salary? No, you don't want to do that. Okay, must have been a loan then. So you've had a loan. Okay, well, fine. We've now got to do paperwork to declare this as a loan. But now the director's had a loan. So you've had your 100 grand. Now when you come to pay your tax bill, the government says, give the government a loan as well. Give the government a loan of 32.5% of whatever loan you've had. So now you've got to give the government an extra 32,500 quid. All right? So you've loaned them money. You've borrowed money, they're borrowing money. During the subsequent year, 2 years, 10 years, however long it takes you to pay this loan back, you get some cash, you may declare a dividend for yourself, and you declare a dividend. Let's imagine that you've got 20 grand's worth of dividend, it's paid to you, you give it back to the company, you go, there you are, I'm giving you back 20 grand out of my 100 grand loan. Fine. At the end of the year, when you come to pay your tax bills, that's 9 months and 1 day after the end of the company's financial year, the government gives you back 32.5% of the money you've repaid. So it gives you back 32.5% of your 20 grand. So now you've loaned money to the government all the time that you've borrowed money. And you can get it back off the government when you give it back. But they've got specific timing when they give it back. That's not the end of it though. So whilst that's striped you of cash now because you've got to give the government 32.5%, you've also had a loan. You've had a benefit in kind. Probably there wasn't an interest charge, so now you've got to pay tax on the interest you never paid to the company. Wow. Neither one of those is any good.
Yeah.
It's a pain. So just don't do it. Don't declare an illegal dividend. Hopefully, that's giving you a feel, skate across the surface here of these topics. That last one I know is very complicated. CTM 20090, or ask for BiteSize Tax 107 if you're a client. I will explain how that works. Obviously, if you're one of our clients, we will be looking after this for you anyway. And that, in a slightly over the time, I'm sorry, Andy.
No, that's fine. That's fine. We're in the 40 minutes. That's or 45 minutes. That's the and this is incredibly interesting anyway. So
yeah.
You know. We got some comments, but I think there's one about there's a capital gains review going on and talk of it going up to income tax rates. Any thoughts?
Okay. Earlier on in the presentation, I said, look, I've got a lot of fear of what's going to happen. Okay. I think that you're going to see some wholesale changes to taxation, right, in the coming years. I think directors, we're going to end up paying more tax. We always pay more tax. You know, obviously, our dividends were tax-free up to our standard rate band. Historically, then it went to £5,000 as only tax-free. Now it's only £2,000. I think there'll be more coming on directors. I think there'll be changes on CGT as well. I do worry about this whole thing where we are not paying national insurance. The tax efficiently, sorry, I know the question was about CGT, and I'll come back to that in a second. Tax efficiently, we tend to pay ourselves at our standard rate, at our tax-free allowance or an NIC allowance. As directors, we tend to have £700-800 a month salaries and take the rest as dividends. I rather suspect that we might end up facing national minimum wage. Now, directors don't face national minimum wage unless you've got an employment contract. So no director should ever give themselves an employment contract, never having had one or get one. I suspect that we might end up facing national insurance costs under national minimum wage. I think that was fairly obviously going to come. CGT, lots of people have been abusing CGT, and the government will always use people's abuse as being the justification of why they are taking more of our cash. Now, I agree that there's probably a small percentage, and I was listening to the Director General of the Compliance Unit yesterday. I was on a conference. She's the boss of the 24,000 tax inspectors, okay, who are saying, actually, there's less than 5% of people doing things wrong. Yeah, but the other 95% of us pay the damn bill.
Yeah.
Because you change the rules because of that small percentage, but it's us that get caught. So I think they'll use some of the misuse of CGT to clobber us. So I think there is a chance for CGT to change, yes.
Right.
Long answer to a short question. Sorry about that.
Yeah, no, it's worth getting into. And so we've got a few other queries, but I think we'll leave it there. I think that's the we can pick up some of this stuff, and you know, this
I'll go onto the forums and see what there is, and
this video stays up within PIN community. So if you have any queries, put it in there. I know, Mark, that you sort of go through to these every so often and just make sure you're answering, you know, some people. But I think that, you know, again, the thing that really comes out of all this is start your company up in the right way. And Chris has actually said this in the comments. You know, start it up in the right way. Start as you mean to go on. Start with a goal in mind. You know, with a roadmap and that sort of thing. I think that comes out every single time.
Yeah,
and it's one of those things that I think that people, they hear, but they never, or they tend not to do. I mean, we see this. I mean, you must see this all the time. People have started
I see
and they come to you because they've screwed it somehow.
Well, I tell you the one I do. I see most frequently. There's two. Obviously, there's the guy that's penny wise and pound foolish. I'm not spending money on accountants, or I don't need advice. I know what I'm doing. There's him. Okay, and frankly, he deserves what he's going to get. The other one isn't. They're the guys that perhaps go on the accelerator, and they're so excited. The penny has dropped, the light is on, they get it, and they want to do something. And so they get home on a Sunday night after accelerator, and they form a company. Them I have sympathy for, and I tend to deal with them slightly differently to the guy that's the penny wise pound foolish. I understand enthusiasm. Bottle it a little bit if you can. Get some advice.
Yeah. And the other thing that I think has come out of this is the sort of mindset of running a business, and I've had to do this. It's not easy to get that mindset, but to think of it as, I mean, I wrote it down here: worker, director, shareholder, bank.
Yeah.
You know, and start thinking of yourself as and acting as that individual. So, you know, if you're acting as a director, you've got to think of as a director. You can't think as a someone who's working within the business. You've got to think as a director, or if you've got to think as a bank.
Yeah.
You know, and that's not easy either. That's something which you've got to sit back and say, look, who am I talking as in this instance? Well,
thank you for that. The classic is the bank, because they go, all right, I see, I've got the company, I found the property, I've got the offers accepted, I've instructed the solicitor, I've got to put the deposit in, I'll put the 50 grand in the company. Good. Which bank has ever loaned money and never created any paperwork? Where's the loan agreement? Where's the minutes that tell the company that it is allowed to borrow money from you? People just don't create any paperwork.
And I think it's because what tends to happen is that because you're doing it yourself, you will brush all those things to one side because you're not going to screw yourself over. That's the sort of mentality. I just need to get this done. I need to get this done. I think if you go at this with the right sort of attitude as I'm going to run a business, it's a different entity to anything that you've ever done before. If you've come out of employment and start as a business owner, it is a different mentality.
Yes,
and I think that's what's come over in a lot of this. And I think if anything, any good has come out of just this one today, is that people will go, am I running this as a business? I might have a business, but am I running it properly as a business? Am I getting the most out of it? Because a lot of the things we talk about, is about putting more money in our bank accounts over time because we've got it set up right. It's not about, how you can dodge tax and things like that. This is about how you can extract as much cash from the hard work you do in the best way possible and do it legally and properly, and just have the right attitude toward it. And I think this is the key to a lot of this stuff. This isn't about working the tax system. This is about making sure that you run your business in the proper way from day one, and getting the most out of it, because that's what we want to do. We want to have that retirement life. We want to have that income every month. That's why we work our backsides off.
And we want good lives out of it, and we don't need to be frightened. This visualization of you walking down the stairs in the morning, and there on the doormat is a brown envelope, and does your tummy lurch? Is it really? Don't run your life that way.
Yeah.
Just don't run your life that way. Look at the brown envelope and go, that's probably some junk mail, because there's no way I'm going to get brown envelopes from the taxman. You just don't need any of that stuff. You just don't need it.
Yeah. Okay, that's brilliant, Mark. Thanks very much for that. We'll leave it there. As usual, if you do email Mark on that pin at propertytaxadvice.co.uk, if you do email, do it with a bit of respect.
Thank you.
This is a give back from Mark to the PIN community. So don't demand free stuff all the time. Just if you've got a query and you want to sort of start thinking about some things, you can email Mark and his team on that, and they will respond to it. But if you're going to start thinking about using Mark on a regular basis, you're going to have to pay him. So I say that every time, because I know that a lot of people do. There's some people will take it.
Some people have done it, and it does offend, because you do try so hard to try to help people. So anyway, lovely seeing everyone again.
Yes, and thanks for that, Mark. And we'll do another one very, very soon. I think we've got another one coming up in a few weeks' time, 2-3 weeks' time. So we'll let you know through the email, the PIN community email. If you're not on that email, let me know, and we'll get you onto the email, so you know exactly what live broadcasts are coming up through the PIN community. So until next time, it's been lovely speaking to you again, Mark, and it's always interesting. You make tax interesting. How do you do that?
I know. Yeah.
How do you do that? Thanks very much. See everybody later. Bye-bye.
Bye now.